You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Today's guest is Ismael Ray Reyes. Ray has been actively investing in real estate since 2005. He has led MI Real Estate in investing in 4 multifamily properties in Alabama, Florida, and Tennessee, totaling 236 units valued at over $10.5 million. In addition, his real estate investing activities, Ray is a lieutenant in the United States Army, and he has served for over 28 years. Hey, man, thank you for being a guest on the show, but more importantly, thank you for serving our country.
Thank you.
Yes, sir. So tell us a little bit about yourself, man.
Yeah, so like you mentioned, I've been in the military for 28 years. Actually, I'm actually retiring now as we speak. I actually have what we call kind of our last, period of vacation, if you will, before I completely go and finish my service. But yeah, I finished. I started out as a private, E1, and I finished out as a lieutenant colonel. So it was a great career, and but it was time to move on.
Right. That's awesome, man. So how did you get into real estate? Like what led you to go in real estate? Because there's so many different ways we can go, but you landed on the path of real estate. So how did you get there?
Sure. I mean, part of it is always. I think there's a sort of an innate thing. Not everybody is born with it, but I was the kid whose favorite game was Monopoly, right? And then so I from the very time from when I was very little, I've always kind of looked at that, and I saw it as a path forward for me. To make that work with the military was the interesting part. So I started out with single family. And I invested for single family for a number of years. And the way I did it was basically when they moved me to one particular location, I would look to invest in that location.
Right.
It wasn't always the most scientific way, but it was a way to do it. And over the years, I've been able to acquire some equity in those properties, and have been able to transition from that.
Gotcha. So you're still holding on to those single families that you initially purchased?
Sure. So I'm actually selling them, and I am buying multifamily with them, with the money from them. And
Gotcha.
so I'm doing that in a kind of a systematic way, trying to not do too many at once. Just basically one at a time as I'm moving into the multifamily space.
Right. Gotcha. So you chose to go from single family to multifamily. What was it that you seen in the multifamily asset that made you want to go into apartments?
Sure. There were a couple things. I think the first one is the longer I invested in single family, and I saw the effort that it took to do that, to buy a house. You're sort of trying to do the loan process for each. You're looking for each.
Yeah.
Going through that process of filtering out properties that don't make sense.
Right.
And then at the end of the day, you have one asset, and you may make, if it's a good deal, and from a buy and hold standpoint, you may make, 300, 400 on cash flow.
Yeah.
And that amount of time that it took to do that, to me, didn't make sense as I was getting older. You start looking at it, and you realize that light bulb came on and said, I need to do this faster. I know this is what I want to do,
right,
but I need to get to where I'm trying to get faster than buying single family homes.
Yeah.
I think that was the main thing. And there's obviously other benefits to multifamily, such as that scalability factor. Your property management fees go down because it's a bigger asset. There's a whole other litany of things, but I think that was the primary one, is just the time factor.
Right. Man, that's you're 100% correct there, man. You're going to spend the same amount of time looking for a deal or underwriting a deal that's a single family home, whereas if it's a 50 or 100 unit deal, you're still going through the same process. You still got to get a loan. You still got to do your inspections. All of it's the same. It's just more units. So you're absolutely right there, man. So what are you doing right now to help you find your deals?
Yeah, so two things I'm doing. One is um, I realize that there are people that have systems already in place to find deals.
Yep.
So what did I have that I could bring to the table for those folks? It's kind of the way I started. So in my case, I had some equity, some
Mm-hmm.
money that I could put in a deal
Yep.
and work my way into the general partnership. And so that was kind of my initial thought. I invested passively for on several deals just to make sure that I understood, how the process worked. And that was always my discussion with the sponsor, the operators, like, hey, I'm going to invest passively, but
Right.
my goal at the end of this is to become a general partner and to actually do my own deals.
Yep.
That was kind of it. It was finding people that were doing it, that were willing to partner with me because I was upfront about what I could offer them. And of
Yeah.
course, after 28 years of service, you learn so many things, and you can add a multiple amount of different avenues that you can kind of work into a deal and support that entity, whether it's, we call them SOPs, but it's processes,
Right.
developing processes. So for me, it was finding that operator that was not so big that they already had all that stuff established, and somebody that was willing to give me a chance
Yeah.
that I could actually grow with,
Yeah.
and it's actually worked out so far.
Right. Right. So, I mean, some of the people that's listening to this, man, they're just like you. They're pretty much in residential, and they're trying to figure out how to get into the multifamily space. So, tell the listeners, how can they find people that's buying apartment complexes, because so a lot of people think it's just something that's not possible. So, where are you finding these guys at?
Sure. So the easiest way to find quite a few of them, is to look for a conference that a multifamily conference, and it can be one that actually can help you understand how to do multifamily.
Yep.
But in those conferences, you will find people that are there to network with other folks, and so that was the best way. I went to several conferences, and make sure you have your business cards. Make sure you can explain what it is that you want to do,
Yep.
and how you can potentially help them, and they are there. And so it's not hard, but you
Right.
you definitely got to look to see which are the big conferences. And Michael Bond's got some good conferences.
Yep.
All you gotta do is search multifamily investing conferences, and you'll get, Joe Fairless has got a great one.
Yep.
There's a ton in Dallas. So most bigger cities will have a multifamily conference that you can attend, and you just have to be open to who's there, and making sure that you meet with as many people as you can.
Right, right. And one thing I want the listeners to really catch with that last thing you just said there was, you said how you can add value to them. What can you do to help them? And that's the way that you need to approach these investors, because they're very busy and they have a lot of people coming to them at all times of the day, days of the week. But if you can figure out what their biggest pain point is and you can find a way to solve that problem, then you're on to something. You got a way to get your foot in the door and just learn as much as you can and to get into it and get going. Those were some great points there, man, for sure. So you've been doing this for a couple years now, but if you can think back when you first got started, man, what was the biggest challenge initially to take that transition over to multifamily?
Yeah, I would say it's just learning how to the nuances of underwriting, the differences, right? So when you're doing single families, you're focused on what are the comparable properties in the area, and how much did the property next to yours or in the area sell for.
Right,
It was
right.
all about what's around you, and to make a transition into the multifamily space, there is some language, some different language. It's not overly difficult, but it's just making that transition and
Yeah,
understand that in a multifamily space. And this is a good thing. You make money based off what you can do to your property,
right.
based on the income that your property can generate, versus being so worried about what the property next to you is doing. It may be the nicest looking property that's next to you, but if they have horrible management, well,
Yeah,
guess what? They're not going to be making the money that you're going to make in your property. So
yeah.
I like that aspect of being able to drive value into a property. And certainly that was the key piece. When you go to that initial conference, those that decide to do that, or read a book or whatever the case is.
Yeah.
It's understanding the differences between that jump, that the language that you'll hear when you're doing single family versus that multifamily space.
Yeah, yeah, and that's some good points, man. Because that's, when you're on the residential side, it's all about what did a house that was comparable to yours sell for across the street or in the neighborhood. Whereas when you get into the multifamily or commercial space, it's all about what kind of income does that property net every year, and then they assess a cap rate, and that's how they come up with a value for that particular property. So you basically control your own destiny when you're in the commercial space. So that's why I really love multifamily for that reason alone. So right now, you said you got properties in Alabama and different markets. So how are you choosing your markets, and which ones are you focused on right now?
Sure. So and that's a key point, because I think location still matters. I mean,
Yeah.
even if you're in the single family or the multifamily, there is two keys that I would think that I think, and most people will understand these, but it's always good to think about this first before you even start looking at individual properties. Is
Yeah.
what is the population in that location that you're looking at? And more importantly, is the population growing? So that's the first one. And the
Right.
second one is, how is the economy doing? So usually, if population is growing, that usually means the economy is doing well. But you
Yep.
certainly want to see a trend upwards with the economy, even if it's not doing incredibly well. The fact that there is some increasing, either both population and the economy is improving, are
Yep.
good things to note when you're looking at properties, because you could find the greatest property, but if there are not a lot of jobs, or for whatever reason the market becomes depressed there, now you're not going to be doing as well as somebody
Yeah.
who just finds a similar property in that other location that is thriving.
Right. Right. And that's definitely a plus. You got to have people to occupy your residence, and if they're moving out because the jobs are not there, then that's going to be a bad situation for you. So jobs and population growth are two very, very big indicators that you want to be looking for. And one thing that I like to look for is also new construction. Like, I like to see the city really investing in the infrastructure. I like to see a lot of builders coming into the area doing some things like that. Lets you know that the economy is going in the right direction for sure.
Yeah,
So
and so sort of diving into the locations that I'm looking at right now.
yeah.
I'm really focused, and not just because I live here, but the Orlando, Tampa, and even up to the Space Coast, which is the eastern, the eastern central Florida area. There's just a lot of economic, growth there. For
Right.
one, a lot of folks are coming in because, in states like New York,
Right.
and others, there's a discussion, and there's some actions being taken to really stymie investing there from a rent control standpoint. And
Right.
those folks are starting to come down. Florida's always been a market where people come, and there's certainly, you have all the baby boomers that are starting to, you hit that age where they're just looking to settle,
Yeah.
and they're coming to Florida. And
Right.
so those are two keys. The other key, and this is something I heard recently, and I agree with, is looking for markets where there is a focus on technology. There's a technological hub of some sort,
Right.
because what that does is that brings in young, educated people
Yeah.
to those jobs, and they're higher paying jobs, and so that'll drive that economy. So where you can
Right.
find, like you said, those places where there's an investment in the area by either just companies moving in,
Yeah.
or certainly it's pro business. It's a pro business area.
Yeah.
There's going to be an abundance, relatively speaking, of money in those areas, and better economic profit.
Right. 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 Now you mentioned something that I know a lot of people was like, what does that mean? Could you just elaborate briefly on what is rent control and how that affects an investor?
Sure. I mean, so this is a problem that we have across the country. There's a lot of folks that, rents are going up. I mean,
Yeah.
for an investor, that's good news.
Right. Right.
But for folks that are, maybe, things are especially tight for, that there is not a lot of there's an increase in the cost of living from them. And if they want to live in certain areas, it's even more. So there, from a investor standpoint, clearly, if you can find that niche where you can provide good housing at a decent price, I think there's growth there. There's an opportunity to grow, and even in these markets, I mean, in these times where there may be a recession at some point. It's been, we've been maybe having a recession for 5 years, but it'll come at some point. And so being in those positions where you actually have something that is good for the community, some place where people can live, that is relatively, not too expensive, but you're still making your money as an investor is great. Having said that, places like New York have really stymied even some very, some ways that investors can make money. In New York, for example, one of the things they're doing is that so long as a place is rented, you can only bump rents, by a certain percentage. And I can't remember what that percentage is, but that sounds reasonable, except when your property taxes go up quite a bit more than that percentage that you're renting, then all of a sudden it doesn't become economically feasible for you as an investor to stick around when you're getting hammered, with increasing taxes, but you can't increase the rent. So those investors will look for a way to move their money into areas where, it's more landlord friendly. It's not about, cheating your tenants, because you need tenants. You need to treat them well. To keep them, so you can't be out of control. But at the same time, it's a business. You're not going to do it for free.
Right. Absolutely, man. That's a very very good explanation of that, man. I really appreciate you taking the time to do that for the listeners. So when you're looking for deals, like, I know certain investors, they want to stay in certain like unit size. Like, so what kind of units are you looking for? Is it like 50 to 100, or like, what are you looking for there?
Yeah, so I'm specifically looking between 50 and 90.
Okay.
Trying to stay in that range for several reasons. One, when you get into bigger properties, you're really dealing with REITs and hedge funds and a whole lot of other players that are in that market.
Yeah.
And so they have quite a few more resources that they can throw at a deal. So it makes it very hard for you to compete in that space.
Right.
The 50 to 90 range, there's still an opportunity for you to potentially be dealing with what we call mom and pop owners, folks that, they've had a multifamily property for years. They've already, their rents, they may own it outright, or they may owe quite a bit less than when they bought it. And so they're not so much worried about increasing rents, and because they're making ends meet very easily. And so they may be getting towards the tail end of their careers, and they want to retire, whatever the case is, that they may be wanting to move out of those spaces. And they're much more willing to negotiate with people than the ones that have a 300 unit property that are basically going to a broker and saying, give me as much as you can for this, and a lot of times they're being unreasonable with their asks. But I think that's the reason why we're staying in that middle area, because I think it's still a sweet spot. You don't have a barrier to entry when it comes to those versus somebody who's selling a 10 unit.
Right.
So it's not like everybody's going to be able to jump to that. But it's still reasonable. Right.
And that's good. That's a very good niche to be in for sure. So when you're underwriting your deals, what are some red flags that you kind of look for to say, hey, this is not a deal for me?
Yeah, so the biggest one is when they have some obvious expenses they're not calculating in their pro formas, right? So they may not have any kind of contracts. So if you own a multifamily, more likely you're gonna need pest control for the general areas. You're gonna need landscaping, and there are some other reasons why you would need to contract somebody to do that. It may be that you're rolling in your trash fees into those contracts. So if you don't have any of that, then how is it being done? I mean, and so it may be that they're not doing it, or it may very well be that the owner is going and doing some of this stuff individually. But that's not what you want to do as an owner of a multifamily. You want to have somebody else do that.
Right.
You're not going in to be a property manager. You're going in to be the owner. And
Yeah.
so
Yeah. Yeah.
that means that you got to be thinking about those additional expenses that maybe they didn't have. I think those are the big ones. And certainly the other one is and it's kind of more overall, when your expenses for a value add property, which is a property that you're hoping to do some work to be able to raise the rents or raise the income some way.
Yep.
For those value add properties, if those expenses are well below 50, if they're like 40 and below, they're not capturing something.
Right.
Those properties should have about approximately on average 50% of the income should be going towards expenses.
Yeah. Yeah. That's some good points. Very good points. So there's a lot of people that's jumping into this game. The Grant Cardones of the world saying "Go big or go home." So, like, what are some of the biggest rookie mistakes you're seeing people make right now?
Say that one more time.
What are some of the biggest rookie mistakes you're seeing investors making that's jumping into this multifamily space?
I think the biggest one, and we sort of touched on it a little bit, is looking at properties in areas where the growth, the population growth isn't there, or the economic drivers aren't there, and so it may be because it's close to home, they're comfortable with it. But
Yeah.
I think something I learned along the way, especially when the military puts you somewhere and it may not be where you want to buy.
Right.
If it's not a good area, a good place, then maybe you don't buy there. Invest where it makes sense, and that's kind of my motto, right? It's like, look to see and figure out where it makes sense for you to invest, and that's where you should focus your efforts, not the other way around.
Right.
The other thing I see rookie investors doing is they spend a lot of time trying to make a deal work. It doesn't work, so the broker's price is, $4 or $5 million above where you think it's worth.
Yeah.
You can provide that feedback to the broker, but if you start doing a full underwriting, that could be hours that you're spending on trying to underwrite a property that from the very get-go, by just knowing how much money it makes, what the expenses should be, in the cap rate, that is not worth that much. So, move on to the next one. There's a lot of competition out there, and if you spend a ton of time just on one deal just because it's the one that that's near you, or for whatever reason you like it, you're gonna miss out on the one actual deal that there is out there.
Right.
So that's the other one. It's just you gotta filter. You gotta filter through, and you gotta do it fairly quickly up front.
Yeah, and that's a great point you make there. So I hear on average, man, guys are looking between 100 to 200 deals before they find one that they actually want to invest in. Is that kind of what you're saying as well?
I think so. I mean, it depends on the area, and it depends on what kind of margins they're trying to get. I think if you're really trying to get the deals where you're trying to get 9 to 10% cash on cash, and 17 to 20%, average annual returns or IRR, then those take a long time. If you're willing to kind of pull that back a little bit and go a little bit less, and your investors are willing to do that, then it may be a little bit easier to find a deal. So people sometimes have to realize that in this market, you're not going to get the deals that you were seeing back in the day. Doesn't mean they're not good deals and you're not going to make money.
Right.
This means it's not outrageously good deals like there were, and you just have to be able to understand where we are in the cycle and take the gains that you can. At the end of the day, it's not about the value of the property, in the long run. It's more about that cash flow. And so you can cash flow through any kind of recessionary period, which is only on average 1 to 2 years. You could be gravy at the end, so long as you are able to cash flow that property, through that rough period. And so obviously that's the key, is making sure that you're locking in long-term debt.
Long-term debt, and buy a cash flowing property from day one. That's key. You get some people that's buying on speculation, and that's a recipe for disaster for sure. Good deal, man. All right.
Most of the lenders nowadays, they help you and make sure they're not going to lend you money on a property that doesn't make sense. Hopefully, that's, I think, the biggest difference between any recession that we hit now versus the one that we had in 2008. 2008, there was just too many people that were just buying on speculation alone, and the lenders just were going with it. Nowadays, lenders have been a lot more stringent about what's a deal and what's not. So they're kind of helping you filter the deals as well.
Yeah, for sure, for sure. All right, so let's go to the next segment of the show. We're going to do a deal deep dive and just kind of go through it, and let's talk about it. So, what's a deal that you've done that you want to talk about recently?
So we initially, my partners and I closed on a deal in July in Tampa.
Mm-hmm.
It was a 59 unit deal, a portfolio deal, and it was interesting because you had an element of both, agency debt, which is your standard Freddie or Fannie debt.
Yeah.
Those are probably the better ones to get because of
Right.
terms that you get with those debts.
Oh yeah.
And the interest rate. But it also had an element. We had within that portfolio of multifamily, we had some quads in that, which really, obviously anything before and below is still considered single family.
Yeah.
We had to get a bridge on those, close the deal, and so and we had to get those because the owner had that mix, and he was only selling one if we bought the other. So
wow.
We had to kind of make it work, and obviously we were able to get to the right numbers.
Yeah.
It made for a little bit more than your typical deal, so it was a good learning point.
Yeah. So, what was the total unit count on that?
It was 59 units, and so about I think 16 of them were in quads.
Okay, so 16 was quads. So what's the value add play that you guys kind of see on this deal here?
Yeah, so this property is in an area that is developing. It's obviously within the Tampa MSA, but more importantly, it's very near University of South Florida, which has a 40,000 student population.
Right.
And it's a growing university. So between the students in the area and the other professionals, the other thing that's in that area is you have a lot of medical, veterans hospitals, and a lot of other medical facilities there. So you have kind of a hub of medical and students. And a lot of those students, they end up staying in that area because the economy in Tampa is fantastic right now.
Yeah.
There's billions of dollars going into that economy,
right,
making it a better place. So I think those were the things that we really liked. It was a C plus. I'm sorry, it was a C property that we were trying to push to a C plus.
Yeah.
It was close enough to. It was actually straddling an economic opportunity zone.
Okay.
Which also made it attractive because
yeah,
as a multifamily investor, you're not necessarily going to be able to to focus on the opportunity zones themselves. You have to create a fund, and there's other ways to do that. But you can certainly ride the wave
right
of opportunity zones because there will be additional investments in that area. And if you can buy, you're not buying for appreciation, but it's gravy when you can get it.
Oh yeah. Great point. So what's the overall strategy? Are you guys buying to hold it for long term, or are you planning on exiting after 5 to 7 years? What's the plan?
Yeah, so our plan right now is to hold for 5 to 7 years, and at that point we have multiple exit strategies. One would be to refinance if it makes sense. You can return most of the money back to the investors it's a syndication. If you can return most of the money to the investors, they'll be happy because they'll take that money and they'll go on and do other things with it, but they still maintain the equity that they have in that property, and then we could continue to cash flow it. That's probably the better strategy if it makes sense. If somebody were to make an offer that's just too good to refuse, then that's the other strategy. And actually, one of my passive investments that I have right now, we're only we're not even in year 3 of a 5-year hold, and we're getting some offers that are making it very interesting to basically move from it and move into something else.
Wow. That's awesome. That's awesome, man. Well, appreciate you going through that deal there. Okay, so we're going to go to the final segment of the show here. It's the lightning round. So what's the best advice you've ever been given?
So the best advice that there's obviously several things we can talk about, but the one that really resonated with me as I was especially making my transition into multifamily is you can't fit a square peg in a round hole.
Yeah.
What does that actually mean? That means that, if you can rack your head trying to make something work, and if it just doesn't work,
Yeah.
you're wasting time. Move on to the next thing. So,
Right.
and that's where I get to the whole thing of invest where it makes sense. So I was trying so hard to make things work, and somebody finally said, "Look, why are you looking there? Look at the bottom line there. I mean,
Yeah.
when you can just look here, you don't even have to be that good. You can be lucky over here, over
Right.
there where you're looking. It's hard, and so
Yeah.
I think that's the key is don't focus on where there is easy value, and
Right.
that's easy to say, hard to do,
Yeah.
but it is one a fantastic piece of advice because I mean it may take a little bit longer to get to where you want to go. But you get there faster in the long run. I mean, because
Yeah.
a bad deal is hard to get out of.
Right.
Whether it's single family or multifamily,
Yeah.
you can avoid it because you're learning. Other people went through the heartache, and you can just learn from their heartache.
Yeah.
Move to where it makes sense
Right.
from an
Right.
investment standpoint.
Absolutely, man. I agree 100%. So what's the best book you've read this year?
Yeah, I really like a book by Bob Byrne. The book is The Go Giver, and it was actually I was at a multifamily conference and somebody said read that book. I said
Yeah.
okay. It's an older book. It's like a 2007, 2008, if I remember correctly.
Yeah.
But I mean, the key thing for me is, and it's so true. I mean, if you really want to, to get ahead, you need to give without worrying about what you're going to get back. I
Right.
think, just going into a deal when you hear the term, and this is obviously something from the book, when you hear the term, hey, it's a win-win,
Yeah.
according to the book, and I agree, you're already thinking in the wrong ways because you already think about how it's good for you.
Yeah.
So the premise of the book is if you're able to give it, there's several values or several laws that it brings to
Yeah.
bear. The biggest one is, you know, just add value to others, and eventually, value will come back to you. But
Yeah.
don't focus on, whether it's the best deal for you right now. Don't focus on what's in it for me, because if you do that, people are going to see through that. It's not going to be authentic.
Yeah. 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 That's that book could be summed up in the law of reciprocity. You keep giving, keep giving, keep giving, and sooner or later it's going to come back to you. Yeah.
That's
All right.
always.
So yeah.
Also,
So yeah. Go ahead, man. I'm sorry.
no problem. In the book, they call it the law of value, right? It's like,
Yeah.
the worth is different depending on how much you give versus how much you get.
Yeah. Yeah. That's right. That's right. So what are some rituals you're doing right now to help you make make you a better investor?
Yeah. So the biggest thing is, and I think everyone at some point has to go through this, especially if when you get to that initial phase and you want to do this, and you kind of see the light.
Right.
You have to start building systems that will allow you to grow, because if you're just an investor, that may be good on one deal, but if you're trying to do this over the long run,
Yeah.
potentially you have to be in it for the business.
Right.
You got to work on your business, not in your business.
Right.
So one of the things that I've tried to do is begin to outsource some of those systems, some of those things that need to be done in a business that are not necessarily core aspects of my business, or I just don't like to do them, right? Because I mean, I want to focus. I want to enjoy myself after 28 years of the service and everything else, and that's a great
Right.
time. I'm in a place in my life where I'm not trying to do something if it isn't fun for me.
Right.
So
Right.
I'm definitely trying to keep it fun. So
Yeah. Yeah.
I've outsourced, for example, the bookkeeping aspects
Yeah.
of the business. I mean, I tell you, my wife and I used to hate tax time because you kind of go through all this stuff.
Right. Right.
So definitely outsourcing bookkeeping is the big one that I just got done.
Yeah.
And the other thing I'm working on right now is and it's not necessarily because I don't like it. It's just because it takes a lot of time, and there is a certain level of expertise that you need.
Yeah.
Is some of the social media
Yeah.
that we're trying to do, right? And so I'm focused right now on capital raising.
Yeah.
That's kind of my focus. Although if I find a deal, that's great too. I'm working with some brokers, but I'm really focused on the capital raising aspect. So
Right.
people have to know you, and they have to trust
Yep.
you.
Yep.
and I invest in my deals. That's obviously a key, and that always helps me when I'm talking to investors. Like,
Yeah.
look, first of all, I did what what you're potentially doing. I was a passive investor,
Right.
and second of all, I wouldn't be putting my money into this deal if I didn't think it was a good deal. And
Right.
so those I think are two of the ones that I'm trying to outsource, and I'm always looking for ways to sort of grow it. And as I grow it, looking for other ways to kind of outsource some of those tasks that are, mundane. They're necessary.
Right.
They're mundane.
Right. Right. Got you. So you talked about systems. So that's the biggest thing you're doing right now to help you improve your businesses, to outsource the things that are taking away your time from doing what matters the most in your business. You would say that's fair?
That's absolutely true.
Okay, got you. All right. Now, last question here. If you can give your younger self one tip in regards to investing, what would that be?
I would say, invest where it makes sense. Don't focus, you already decided that you want to invest. I'm not trying to convince anyone. I wasn't convincing my younger self to invest.
Right.
But I would like to convince myself, hey, don't work so hard, work smart.
Right.
So I would say definitely look for where it makes the most sense to invest your money. Because, if you make a bad deal, you could be stuck for a while.
Right.
I think ultimately so long as it's not a horribly bad deal, you can probably work your way back from that.
Yeah.
It's a heck of a lesson.
Yeah.
University is a heck of a lesson, and it costs a lot of money too. So it's not, the idea is not to stop people from doing deals.
Yeah.
Just, thinking through as much as you can and making sure that you're being methodical about where you want to put your money.
Right, man. That's a very, very good point. All right, man. Well, Ray, tell my listeners how they can get in touch with you.
Yeah. So the best way is through my website. It's www.mirealestate.us, or my phone number, and I certainly will take calls, 954-667-9739.
Gotcha. Well, hey, man, I really appreciate you coming on the show today, and let's do some business together, man.
All right. Looking forward to it.
All right. Thank you, man.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.